Today's video is all about moving average secrets, and we're going to be looking at how to identify the beginning of a trend, the end of a trend, but also the direction of a trend as well, using a variety of different moving averages, and we're also going to be doing it on different time frames as well. So to kick things off, I've got two exponential moving averages on the chart, an 8 and a 20. Now, in very simple terms, when we have this 8, this yellow moving average above the blue, we have an upward trend. When we have the 8 moving average underneath the 20 moving average, we have a downward trend. So if we look at this on the chart, it tells us that we have an upward trend from here to here, which looks right. And we have a downward trend from here to here, which again looks right. Now, we can't trade moving average crossovers on their own, otherwise everyone would be multi-billionaires. So moving average crossovers on their own are not going to work, but we can use them for direction. Now, there's three parts of moving averages. There's the order, which is what I've just described. There's the angle of the averages. So if we look at the moving averages here, in this section, we can see that they are a lot flatter through this period. And you can also see the price action is far more stable, far more flat, consolidating sideways through this period as well. And when the price is aggressively moving down through here, we see the angle of these averages is very steep. Similarly, when we're trending away to the upside, the angle of the averages is steeper. So we have the order, we have the angle, but we also have the separation between the averages. It's not just about the angle, it's the distance between them. As long as the distance between them is increasing, that means the trend is continuing to get stronger. And it tells us that up until about here. Okay, similarly, the moving averages are getting further apart, further apart, further apart, until around this area. So it's not just the order or the angle, it's also the separation of these averages as well, telling us how far the trend is moving. Now, take this wonderful upward trend as an example. We see from here, angle pointing up, getting further apart, trend is getting stronger, 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 and it's really this candle that pulls down that flattens out this average and brings them closer together, which tells us we're probably in phase 2. We're no longer seeing movement to the upside. Doesn't mean we're not going to get a bounce and continue going back up, but it means that we're no longer seeing continued expansion to the upside. Similarly through here, nice obvious example, the angle through here is getting steeper and steeper and steeper. The separation is going from very close together to getting more and more separation between them, which means the trend is getting stronger and stronger and stronger. But you've got to remember that the price moves the averages. The averages don't move the price. So while the angle and the separation are important, the most important thing is actually the order of which way round they are. Now we can take things a step further as well and add an additional moving average. I'm just going to add a 50 moving average as well. I'll do it in red so it's very easily visible. Okay, so now we've got ourselves an 8, a 20 and a 50. Now when the 8 is above the 20 and the 20 is above the 50, we have got certain upward trend. And when we get the 8 or the very smallest moving average cross over the 20, so we've now got them out of order, we would essentially be saying through here that we now have, from this point, we are now uncertain as to what the trend is. And you can see it does actually go fairly sideways through here until they start separating again. And then we have downward trend, we have the moving averages separating, we have them in the correct order, and we see downward trend. Similarly, we would say through this period, from when they cross over to when they're all back in alignment again, we're unsure as to what's happening in this area. And to be fair, in this case, it does just accelerate, rebound, and shoot off. But if we say we're not certain it's trending up until here, that's playing it safe and giving us a defined upward trend to work with, which is great. And we can go back further than this as well. We can take periods through here where everything is in alignment. 8 underneath 20, underneath 50. We get a wonderful downward trend. They cross over. We're uncertain. Okay. Similarly, we have 8, 20, 50. From this point, we're saying upward trend. And from here, we're saying we're uncertain. And it does actually go pretty sideways until they start fanning back out again. So using 3 moving averages is a great way to determine whether or not you're in a sideways patch or whether or not you're in a trend. Just like here, 8 is above 20, and then the 20 crosses over the 50 here, we've got upward trend. They start squeezing together, they cross over, we're no longer in upward trend, and you can see we actually do spend a period of time there sideways, and then we spend a brief period in borderline upward trend through this area here. Okay, and before it crosses over and we're unsure again. But that's a very simple way of making sure that you can understand the trend using moving averages. Now, moving averages are not foolproof, they're a visual guide, and I'd highly encourage you to stick to a maximum of 3 moving averages. Some people, like myself, prefer to just use 2. I use them as hard and fast rules in some of my trading systems where the 8 and the 20 purely define the trend, and I assume that the trend is going to be whichever way around they are. Okay, so for my trend following systems that don't have sideways filters or consolidation filters, I assume that when the 8 is above the 20 or the 8 is underneath the 20, that we've got trend. All right. Whereas other people don't like having drawdown periods through sideways patches, and instead other people prefer to use filters like a 50 moving average as well to make sure you don't get caught out in these areas. Now, the downside to using 3 moving averages is that you're going to get in late. Okay, so an example here is right there. 8 crosses 20, I'm assuming upward trend, but if you wait for the 50 moving average, you don't know it's upward trend until here. So you will get into trends later, but you'll avoid more sideways patches like this. So if you want to play it safer, smaller drawdowns, less chance of getting caught out with this stuff, use 3 moving averages. Instead, if you'd rather be there at the beginning of the move, you're willing to have more winning trades, but also more losing trades, then just take off one of the averages. I'll just delete this 50. I prefer to use 8 and 20. That's a shorter term trend. And stick to the 2 moving averages, and they'll give you the trend in the shorter term. Now, you will know from a moving average standpoint that we can add on others. So there's different types of moving averages. There's simple moving averages. There's exponential moving averages, there's weighted moving averages, there's whole weighted, there's tons of different types of averages. But if we just take simple moving averages first of all and put on a 20 simple moving average in, let's say, bright pink, you will see that the exponential moving average, the 20 here, turns up first. The simple is much slower. Okay, so exponential moving averages, weighted moving averages, all these other types of averages other than a simple moving average just try to move faster than a standard 20 moving average of the last 20 candles. And you'll find that simple moving averages, you could use 20, 200, whatever you like, but they're going to move slower, they're going to be less erratic. But you'll see here, whereas the exponential moving average is rolling over sideways here, the simple moving average is slower in turning over. Okay, it's something that is just a characteristic of the simple moving average treats every single candle equally, whereas the exponential moving average puts more weight on the more recent candles. It says the more recent price action is more important than the older price action. So what you want to do is make sure that you're using exponential averages. You don't need to use simples. You could put on a 200 simple because you will see price react against 200 simple moving averages, because some of the bigger funds do use them, and you will get some bounces off of daily 200 simple moving averages, but that's not going to give you many trading opportunities. So instead, I tend to stick to the shorter term 8 and 20 moving average, and I use that as a trend filter for up or downward trend. And I always assume we have some kind of trend because I want to be there at the beginning of the move. That's it for this video. If you've got any questions, leave them in the comments below and I will respond, making sure that I answer your question and be as detailed as you like. The more detailed you are on your question, the better response I can give you. Hopefully you found this video useful. Please make sure that you hit the like button and hit the subscribe button as well, because there's regular content coming out on the channel designed to help you become a better trader.